Big day for stocks. Lots of record highs in the mix. Call it a relief rally after Fed Chairman Ben Bernanke once again said monetary policy will remain accommodative for some time. Is the rally real or just a reflex? Let's ask Clark Winter. He is Chief Investment Strategist at Clark Winter Enterprises and former Chief Global Investment Strategist at Citi and at Goldman Sachs. So is the reaction to Bernanke on target, or are we being overly reactive here?
I think it's on target. The world really wants to go back to work. That's the big topic. And as we mentioned earlier, people were paid for a long time to park money but not be productive with it. So what's happening all around the world, particularly in levered economies, is this massive shift of capital from making money merely on money to making money because you're actually doing something productive and improving the productivity of your business. So there's a long way to go and for the economy to grow, particularly if interest rates stay low for a long time.
So in terms of the stock market reaction, there was a lot of negative reaction to his comments back in May. Was that reaction all wrong?
Well, a lot of this is driven by pure math. People have pair trades on, and they'll get affected when the math moves either way. So that'll create a lot of trading distortions, particularly those who live day to day. But investors, I think, should think longer term. What's really going on in the economy is we're going to have a period of prolonged growth with very low interest rates. The risk is we become Japan-like, where we have very bad and slow government policy, and nobody really has confidence. So it's no longer about money. It's about confidence and the sense that everybody feels there's more opportunity than uncertainty ahead. And on the margin, let's go to work as opposed to let's sit and watch.
So the vast majority of stocks are higher today, something like 85%. So what does that tell you about the depth of this rally?
That more and more people are figuring out that cash is boring, bonds are really dangerous, and that finally it makes sense to go back to work with your money. Or sitting on the sidelines, you get paid nothing for waiting. Remember, in the 70s, you got paid a lot of money for just waiting. In the 80s, you got paid money for parking, and now we're back to work. That's probably the most important thing, and people are slowly figuring that out. And I think they think the damage is done. There's no more impending disasters out there that are obvious. So on balance, let's go back to work.
We focus so much on the Fed, but we are going to be focusing soon and starting to focus on earnings. A couple big banks reporting on Friday. What do you think we're going to hear there, and how will that affect the market?
I think Washington has realized that they have to allow banks to actually make money. They can't blame them for everything and punishing them or wipe them out without devastating consequences on capital allocation throughout the economy. So slowly people are saying it's okay. Now it's hard for a bank to make money in a yield curve environment like this. And so you see them pushing towards massive fees. Every time you touch or breathe, you get another fee. That's not necessarily great, but you've got people actually figuring out how to make money. You've got capital flowing through the system again. So I think we're going to see banks gradually make more money. And that's a good thing for capital allocation, middle, small companies who depend on banks for their credit.
And earnings overall, how do you think the market reaction will be there? I mean, I think Reuters estimates are for about 2.5% growth.
They could be higher if people on margin feel, as I said earlier, it's time to really go back to work and they feel optimistic, but I think that's a safe number. Europe's not going to surprise us with the crisis. Asia's not going to surprise us with the crisis, although they always happen in August, so I could be dead wrong. But I don't think we see any major overhanging events. There's no hangovers out there. So on balance, people are saying, I can't afford to just sit back and do nothing. And savers making 1% say, after tax, that's nothing. The Fed's job is not to promote a high enough interest rate for savers. The Fed's job is employment and economic activity. So savers will be hurt in this environment. So again, on balance, savings are going to find a way to go back to work instead of just park and do nothing.
So it's safe to say you think people should be putting money back into the stock market at this point?
On balance, you're going to be more rewarded than you have been for the last 20 years for actually putting your money at risk in productive enterprise. If I have advice to give the average investors, don't do anything you don't understand. There are many things that we need fundamentally more of, and there are companies that are fundamentally well run. And buy something that you can sleep. And if you don't understand it, ask your son or daughter to explain it to you. And if you all don't understand it, don't do it, because there's enough things out there that are eminently comprehensible.
So on that note, where should people put their money?
On things you could sleep with that are going to be around for a long, long time. So I've been saying it for a while, but the great global brands around the world that have figured it out. These are companies not exposed to refinancing risk. They've got great global franchises. They're a little bit boring at times, but boring isn't bad. You know, low handicap golf is boring, but it's not bad. You know, predictable innings in tennis the other day, they're not bad. So the solid, reliable, boring is probably better than exciting, and I think you can sleep on it.
All right, we'll leave it there. Thank you so much.
My pleasure.
Our thanks to Clark Winter. I'm Bobby Rebell. This is Reuters.